Businesses around the world are awaiting clarity on the U.S. tariffs that are expected to be announced on April 2nd. Our guest says, sure, there'll be volatility over the next few weeks, but he does reckon there'll be new highs for stocks later this year. We're joined by Mike Archibald, Vice President and Portfolio Manager, AGF Investments. Thank you very much for coming on the show.
Thanks for having me, Andrew.
So you think that arguably once the worst of the tariff news is known and digested, stocks will begin heading up again?
Yeah, certainly. We think known outcomes are obviously better than unknown ones, and we're getting closer to April 2nd, which obviously looms large with respect to what the tariff outcomes are going to be. So certainly the last week or two, we've seen a much more balanced tone, a negotiation tone from the U.S. administration. We think that as you get to April 2nd, certainly you'll get a better sense on what the tariff is going to look like for various countries around the world. Definitely not a one-size-fits-all approach here. So certain parts of the world, China as an example, likely to see higher tariff rates than other areas like Mexico and Canada and the UK and Europe. And I think what's been important is that the Trump administration has effectively allowed for some negotiation to enter the fray here. And so investors like me are looking for some certainty on what the tariff numbers are going to look like, and then we can build those into our models and make better decisions. So certainly seen a pullback in growth expectations in the US marketplace from around 3% to call it around 2%. We think that's largely priced now into stocks. And so as we get a little bit more clarity in the next week and a half or so, we think stocks start to ascend higher again.
You don't see an actual U.S. recession on the horizon?
We don't. I mean, certainly you've seen a pullback, as I mentioned, in growth. I think what we're expecting to see is a bit of a reset here in Q2, just with respect to earnings expectations, but we don't see a recession on the horizon. Obviously, business confidence, investor confidence has been frozen really here once tariffs have started to take the front page of the newspaper here. As we get a little bit more clarity, we think growth will start to pick back up. So we'll see a reset of expectations, we think, in Q1 earnings here. S&P earnings were expected to grow somewhere around 14-15% earlier this year. We think that looks probably more like 9 to 10%, and we've already started to see some revisions moving to the downside. So I think we're going to start to flip the page, Andrew, to more of the positive growth catalysts that we see on the horizon once we get past early April.
It's interesting. I mean, you are quite contrarian. You think that at the end of Q2 into the second half of the year, we could get synchronized global economic growth despite all these tariffs.
Yeah, so certainly we're going to have to reset, and there's no question that we're going to see volatility here in the next 4 to 6 weeks, but there's a lot of things that we view very positively about the growth backdrop. So think about European stimulus. Germany is spending at levels they have not in at least a decade. That's going to move growth up in Germany, and there's other European countries that will likely follow suit. China continues to stimulate aggressively on both the fiscal and monetary side, second largest economy in the world. That will help global growth prospects. And then we're going to start to move in the U.S. to things that are beneficial for growth. So we're going to get tax cuts later this year is our view. We're also likely to see a bigger push for deregulation. All of those things are going to result in better growth outcomes as we move through the second half of the year. Couple that with the potential for central banks to continue to reduce rates potentially. And you've got a good backdrop for coordinated global growth at the end of 2025 and into 2026. And so parts of the market that should typically work well there would be cyclicals. And so that would be obviously financials, industrials, commodities, and technology. And so those are areas of the market that we're focusing quite a bit of time on.
The one idea you have for us, and we're looking at some of the sectors you like there, financials, industrials, commodities, tech, Arc Resources, big producer of oil, also natural gas, liquids. Remind us why you favor Arc Resources.
Yeah, so we like, from a macro perspective, we're quite favorable towards natural gas, and then we believe ARC to be the best positioned company in North America. So on the macro side, supply and demand have really come into balance in the gas market for the first time in a number of years. Some of that's being driven by, obviously weather. We saw a colder winter, and so storage levels are below long-term averages. But you also have some other big benefits in terms of AI build-outs, data center build-outs, and obviously reshoring back into the U.S. As we bring more capacity back into the U.S., you're going to need more power for those buildings, and natural gas is a natural area that will benefit from that. We really like ARC for a couple of reasons. Really solid management team, really good balance sheet, a lot of drilling inventory to continue to grow production over time. There's been two catalysts that have occurred recently that have really driven the stock to all-time highs here. So in Q4 of last year, they finished a new facility and brought that online. That's getting closer to full capacity. That's going to add a huge amount of free cash flow for the company this year, which they're going to use to buy back stock and increase dividends. And then a couple of weeks ago, they announced a deal with ExxonMobil, where 25% of their long-term production is going to be sold into international markets where pricing is significantly higher. So that will obviously help the financial statements for the company as well. So new facility, very cheap stock relative to peers, really well-managed company. It's a business we've been adding to aggressively throughout the first quarter. We see good short, medium, and long-term outlook for ARC Resources.
And then finally, Robinhood Markets. They are taking market share from other established players with their free trading.
Yeah, so brokerage and trading platform, I think the real thing here is this, we view this as kind of a long-term secular winner here. So as you see a generational wealth transfer from the baby boomers towards the millennials, they trade differently. They look for different types of platforms, and Robinhood is a very popular one. So as you mentioned, smaller account balances, but really taking share from the incumbents like Schwab in the US market. And so you can trade stocks, you can trade crypto, ETFs, options. They've got some new product launches into prediction markets. I think they're going to launch some other products related to robo investment advice as we move through 2025. So really high growth business. We can see 25% plus organic growth in this business for the next 5 years. And as we said, it's a really good long-term secular winner. So as you know, it's a high growth name, and high growth stocks have been hit here in the last couple of weeks. We still see a lot of runway for this company to take share and be a big winner over time.
Thank you very much indeed for joining us, Mike. And Mike Archibald, Vice President and